Something changed this week, not on the price chart, not on Twitter. In the actual plumbing of the global financial system, and the world completely missed the signal. While the crowd was debating whether we're in a bull or bear market, a French bank just quietly launched a tokenized euro on the XRP ledger. A U.S. Senate subcommittee chair said she's fairly confident a major market structure bill marks up in the middle of May. And someone who used to run the CFTC, a former acting chair, is now publicly using the word quadrillions to describe what's coming to this space. Not trillions. Quadrillions. Let me ask you a brutal question. Do you actually understand what that number means for the asset sitting in your wallet? Pull up a chair. We're going deep today. Welcome back. If you're new here, this channel exists for one reason: calm, data-driven analysis of what is actually happening in the XRP ecosystem. Not hype, not hopium, not emotion. Just structure, evidence, and math. I'm Plan XRP admin. Today we decode 3 converging signals that, when you see them aligned like this, change the entire picture. Let's get into it. Let's start with the hard truth. The vast majority of retail investors are measuring XRP's progress in the wrong unit. They're measuring it in price. Institutions are measuring it in flow capacity, and that distinction, that single mental shift, is the entire ballgame. Here's what I mean. The global financial system moves money across borders using a patchwork of correspondent banking rails, Nostro and Vostro accounts, and a messaging layer called SWIFT. Right now, approximately $27 trillion sits locked up in those Nostro-Vostro accounts around the world, idle capital, just parked there to pre-fund cross-border transactions. That is dead money. That is $27 trillion that could be deployed, invested, generating yield, moving the economy. Instead, it's sitting in accounts as a buffer for a system that is fundamentally slow. XRP was designed to eliminate that buffer, not reduce it. Eliminate it. When you use on-demand liquidity, Ripple's flagship product, you don't need pre-funded accounts. XRP acts as the bridge asset in real time. One currency in, XRP for 3 to 5 seconds, destination currency out. The Nostro account becomes unnecessary. Now ask yourself this. If you're a global bank looking at $27 trillion in locked liquidity you could unlock today with the right infrastructure, what are you waiting for? The answer, until recently, has been regulatory clarity and institutional-grade market infrastructure. And this week, both of those gates just moved considerably closer to open. Think about what SG Forge, the digital asset arm of Société Générale, one of Europe's largest banks, just announced. Their EUR convertible token is now live on the XRP ledger, not on Ethereum, not on some private chain, on the XRPL. That's a multi-trillion-dollar European financial institution choosing the XRP ledger as a deployment target for a tokenized currency. That doesn't happen by accident. That doesn't happen without months of due diligence, legal review, and infrastructure vetting. Silent actors don't move loudly. They move precisely. And SG Forge is not alone. We are watching the architecture of a new settlement layer being constructed, beam by beam, institution by institution, right in front of us. Let's do the math that the retail crowd consistently ignores. The global cross-border payments market processes approximately $150 trillion annually. The foreign exchange market turns over $7.5 trillion every single day. And sitting above all of that, the derivatives market, the financial instruments layered on top of underlying assets, totals somewhere in the range of $1.2 quadrillion. That's the number Caroline Defam, former acting CFTC chair, is now openly referencing when she talks about what blockchain settlement could touch. Now here's where the math gets interesting. XRP has a fixed supply of 100 billion tokens. It will never change. There is no central bank that can print more XRP. Approximately 55 to 57 billion tokens are in circulation today, and exchange reserves, the XRP actually available for immediate purchase on trading platforms, have been trending toward multi-year lows. So here's the equation I want you to sit with. If a financial institution needs to move $1 billion across a corridor using XRP as a bridge asset, the price of XRP directly determines how many tokens are consumed in that transaction. At $2 XRP, you need 500 million tokens for that single transfer. At $20, you need 50 million. At $200, you need 5 million. Think about that math. Fixed cap, decreasing exchange reserves, increasing institutional demand for cross-corridor settlement. The higher the flow volume, the higher the required price for the system to function without consuming the entire liquid supply in a single day of transactions. This isn't a moonboy fantasy, it is a design requirement. The price of XRP isn't just a speculative number. At sufficient institutional adoption, it becomes a mechanical necessity. If you have a problem with that math, you don't have a problem with me. You have a problem with arithmetic. Brad Garlinghouse said it plainly. A remittance company using Ripple's technology dropped per-transaction costs from $20 to $2 and saw an 800% surge in usage overnight. That is what happens when you remove friction at the infrastructure layer, and we are nowhere near the ceiling of that adoption curve. While the crowd is debating price candles, let's look at what the smart money is actually doing. First, SG Forge's EUR convertible is live on the XRPL. A European systemically important bank chose the XRP ledger as part of its multi-chain deployment strategy. That language, multi-chain deployment strategy, is not the language of a bank experimenting. That is the language of an institution building production infrastructure. Second, Coinbase is adding XRP to its TAS, its Trader Advanced suite, alongside Bitcoin, Ethereum, gold, and oil. Read that list again slowly. BTC, ETH, gold, oil, and XRP. Those are the assets Coinbase believes institutional traders need professional-grade futures infrastructure to access. When you are in that company, you are not a speculative altcoin. You are a settlement instrument. Third, Senate Subcommittee Chair Cynthia Lummis stated this week that the Digital Asset Clarity Act is nearing the finish line. Her words, "Fairly confident we will be marking up in the middle of May." She described the White House and Treasury as great to work with on the bill, and said concerns are being put to bed one by one. Ask yourself, does a sitting U.S. senator speak with that level of specificity and confidence if the votes aren't there? Institutions don't signal without positioning first. And then there's this. SWIFT, the backbone of the existing correspondent banking system, put out a piece this week specifically about how collaborations are going to reshape the future of cross-border payments. That is SWIFT acknowledging the new architecture. And in that same piece, banks that are part of SWIFT's network and also work with Ripple are highlighted. Brad Garlinghouse said it himself. Ripple isn't competing with SWIFT. Ripple is the settlement layer. SWIFT is the messaging layer. Collaboration over competition. That's not spin. That's the actual division of function in the emerging hybrid system. Institutions are not panicking. Institutions are positioning. There's a difference. Retail sells the dip. Smart money signs the NDA and builds the corridor. So, what are the specific triggers on the near-term horizon? Let me give you the structured view. Mid-May, the Digital Asset Clarity Act markup. If Cynthia Lummis's timeline holds, this is the moment the legal fog begins to formally lift for U.S. institutions. The risk premium attached to XRP is not just psychological, it is legal. Compliance departments at the world's largest asset managers cannot touch an asset whose regulatory status is undefined. That changes with this bill. The gate opens, ongoing but accelerating, the XRP ETF pipeline. Multiple applications are in process. We watched what happened to Bitcoin the moment spot ETF approval came through. Institutional capital flooded in within days. The XRP ETF is not an if, it is a sequencing question. May 1st and beyond. Coinbase, TAS listing for XRP. Professional-grade futures infrastructure for institutions that want to take large positions without moving the market. Less slippage, more size, more participation, multi-chain expansion. SG Forge's EUR convertible on XRPL is not a one-off. Ripple has publicly committed to championing XRP's role across tokenization, DeFi, and cross-border settlement. The pipeline of tokenized instruments coming to the XRPL is accelerating. Every new tokenized asset on the ledger increases utility. Every increase in utility drives demand for XRP as the native bridge asset. The fuse is lit. The sequence is loading. The only question is whether you're watching the signal or the noise. Here is the supply reality you need to internalize. 100 billion XRP, fixed forever. Escrow releases of 1 billion per month, but historically, the vast majority gets relocked. Exchange reserves are trending toward levels not seen in years. And as institutional ODL volume grows, as tokenized settlement flows through the XRPL, as the Coinbase TS opens the door to large block institutional trading, that liquid supply gets thinner. The window for accumulation at these prices is not infinite. It never is. But the confluence of a landmark market structure bill, a major European bank live on the XRPL, and a futures listing alongside Bitcoin, Ethereum, gold, and oil, all arriving within the same week, is not coincidence. It is convergence. And convergence, in financial markets, is what precedes the repricing event. The door is not shut, but it is closing. Here's the summary. A former CFTC chair is using the word quadrillions. SG Forge, a major European bank, just went live on the XRP ledger. Cynthia Lummis says the Digital Asset Clarity Act marks up mid-May. Coinbase is placing XRP in institutional futures infrastructure alongside gold and oil. And Swift is publishing pieces about how collaboration is reshaping cross-border payments, featuring banks that work with Ripple. Every one of these is a brick in the same wall. Individually, you can dismiss any single one. Assembled, they form a structure that is unmistakable. History does not reward comfort. It rewards the people who paid attention when the room was still quiet. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational, and as we always say, we don't wait for the future. We plan for it. Comment convergence below if you made it to the end. I want to see who's actually paying attention. I'm Plan XRP admin. The math doesn't lie, and the architecture is almost complete.